Good morning, everybody. I hope that everyone is doing well. This is Dan Smith with Tradition Mortgage. Appreciate everybody joining here today. I got just a handful of items to run through. Hopefully some good updates on some exciting loan limit changes, a little bit bigger than I had expected. So we will go ahead and dive right in here. First off, want to again thank everybody and appreciate you all for your business, for choosing to work with Tradition. Myself, our team, and our reps here greatly do appreciate that. I hope that everybody had a great Thanksgiving. Crazy to think we're almost into December here, into the holiday season. Definitely tell winter is here. Although it seems like it's going to warm up again here the next couple of days. So hopefully the mild temps stay around here with us for a while. All right, let's go ahead and dive right in here. So the first topic is, it took a little longer than expected. I thought we might have the information on the increased loan limits before Thanksgiving, but they were pretty consistent with what they have done in past years. It was right around Thanksgiving. So just yesterday, Fannie Mae and Freddie Mac through FHFA, who is their regulator, did announce their increased conforming loan limits for 2024. There was expectations that it would be in the low 750s. My guess was just below 750, and I ended up being rather low. So the 1 unit limit increased up to $766,550. So it's an increase of 5.5%. From a percentage basis, lesser than the last couple of years, but it is another $30,000 plus increase from where we are at for calendar year 2023. So these can be implemented now. We don't have to wait until 2024 to use these. We can use them now, but we do need to have an AUS approved eligible message, and that's going to get updated in the next week or so for Fannie Mae. We have not heard when Freddie Mac will increase that. So if you have a deal that maybe is at the current conforming max and you want to increase it for a particular reason, get with your rep here from Tradition, talk through that, and we can see timeline of that when that will make sense. But with obviously by the end of December, but in the next couple of weeks here, everything technology-wise will line up. But that is the conforming loan limit for next year is going to be $766,550. With the conforming loan limits, we have FHA changes as well. So the national FHA loan limit did increase up to $498,257, which I learned something. So that is set at 65% of the conforming loan limit. I believe that is just how it works every year. They back into that number based off of the Fannie and Freddie limit. So here in the Minnesota metro area and some of the surrounding counties, and then the only county in Wisconsin is Pierce County that are above that $498,257. Those limits are $515,200. So what is that? About $17,000 more for the Minnesota metro here, and then Pierce County, Wisconsin. In Minnesota, the non-metro limit is at that $498,257, the standard national limit. And then all of the other counties in Wisconsin except Pierce are $498,257. So the new loan limits with FHA, an important distinction here to make is how using these loan limit increases will change versus Fannie Mae and Freddie Mac. With FHA, we cannot use the new loan limit increases until after January 1st, 2024. So that's only with new case numbers for FHA issued after 1/1 of 2024, so after the new year. So Fannie and Freddie, we can use the new increases before the new year. With FHA, we have to wait until after the new year. So basically it would be new applications after the first of the year. But some exciting news there with some nice increases. All right, next topic here, talking about Fannie Mae and Freddie Mac first-time home buyer at 100% of AMI. So Fannie Mae and Freddie Mac, obviously there's lots of different price adjusters that they have as it relates to property location, income, credit score, not so much DTI, LTV, occupancy, purpose, all those different things have to go into impacting the rates. I think everybody realizes that it's a combination of all those different factors for their risk-based pricing, sometimes to the positive, sometimes to the negative. So Fannie Mae and Freddie Mac does give a little bit of a pricing increase, meaning a lower rate, if you have a loan where you have at least one first-time home buyer and the income on the file, just the qualifying income, is at 100% of the area median income, AMI standing for area median income. So you will get a slight pricing incentive for a primary residence where one borrower is a first-time home buyer and your qualifying income is 100% of AMI. So I am going to jump over to this Fannie Mae lookup tool. Freddie Mac has a similar. So I have the link to this in the agenda, but if you want to see for a particular property what the area median income, so this is also where you can see the Home Ready, Home Possible, 80% of AMI limit. So all you got to do is type in an address. Just type in an address here that I know well, East Pleasant Street in Mankato. So it's going to pull up that address, and it's going to give you the area median income. So that 100% of area median income for this property is $99,100, 80% of AMI. So that's to give you that Home Ready and Home Possible. Obviously, we'll give you an even extended pricing incentive. So basically lower rate, better pricing. So that it makes a property eligible for Home Ready and Home Possible. But you don't necessarily have to have that income at Home Ready and Home Possible to get a slight pricing incentive. It just has to be at that 100% of AMI. So here is the tool. You put in the property. You can look up what the 100% of AMI and then 80% of AMI, and we would need that to be the qualifying income that we are using. So it can make a big deal, especially if you got a borrower that might be shopping with a different lender as well, to make sure we're leading and going with our best rate possible. You got a deal that we're looking at pricing. Obviously, your rep here at Tradition is going to walk you through that and help you there as well. Just something to keep in mind. All right, so here's just a snapshot of what that might look like. This was a different property address. This was in the metro where that AMI is 124.3. So a little bit different there. So you want to make sure you search it specific to that property because it is going to vary property by property. Next thing here, I want to talk a little bit about lender-paid temporary buy-downs. There's a lot of different lenders that I have seen that have been advertising this pretty hard lately. As I've talked about in past calls, we have several different buy-downs that are eligible for Fannie Mae and Freddie Mac. You got a 3-2-1 buy-down, a 2-1 buy-down, and then a 1-0 buy-down. So the 1-0 buy down, your rate, it's only going to be good for 1 year. The first 12 months after closing, your first 12 payments are going to be 1% below the note rate. The challenge with a 3-2-1 buy down and a 2-1 buy down is they just get to be really, really expensive to be seller paid. Sometimes new construction builders might be willing to pay that, but especially on the 3-2-1 buy down, I mean, you're talking 5% is what it's going to cost to pay for that. It's a great deal for the borrower, 3% below the note rate for the first year, especially in the rate environment we're in today, but it just gets to be really, really expensive for the sellers to pay those. So a lot of lenders out there are pushing the 1-0 lender paid buy down. So this is where the rate would be 1% below the note rate for the first year, and it would be paid by Tradition Mortgage via a lender credit. So just a quick sample here. So at a 7.75% rate, luckily rates have been moving to the positive lately. So this is from a couple of weeks ago where we'd be. But for this particular example, so the borrower pays 6.75 for that first year, and then that would be paid with a lender credit, the cost of it about $2,800. So we got to make sure we're slowing down and looking at the pricing. It's going to depend on the overall borrower profile. If we can make it work, because there's just not a ton of premiums. As you've probably seen, most deals that are out there today, all across the board from everybody, is going to include an origination fee. So for this, it almost certainly would include a 1% borrower origination fee. But if you're seeing people that you're talking to are saying, hey, I saw this was offered by this lender, this bank, whoever it might be, just know that it is an option that we have. Oftentimes we look at the positives versus the cost of it, and sometimes it's really not worth it for them. But just know that it is something that we do have that we can talk through and look and see maybe it does make sense. So we can talk through and see what the best option is for the client. Next topic here, I think it's the last one that I got today, is we're keeping it fairly short here, is the options for a soft credit pull. So I'm going to ramble a little bit here and kind of talk about what is going on with trigger leads. So for companies that are buying leads to try to originate mortgages, there's not a lot of leads out there to purchase. There's not a lot of places going to lead generation sites to get information on buying houses. So a lot of lead generation companies are doing what's called trigger leads based on credit pulls. So credit companies, being the credit bureaus, essentially sell when people have their credit pulled based on the industry that pulled it. So mortgage, obviously for us, when somebody has their credit pulled by a mortgage company like Tradition Mortgage, it's got nothing to do with us or our credit service provider. It is all about the credit bureaus. There are companies that monitor credit. It's hard to believe that this is even legal, but it is, that monitor people's credit, and when their credit is pulled, they get a trigger lead that, hey, this guy had their credit pulled for a mortgage inquiry. You might want to reach out to them. So we've had clients that, we've pulled credit, and just naturally through the credit bureaus, they might get 20, 30, 40 calls over a period of days from other mortgage lenders. With the trigger lead. It's a massive issue industry-wide, certainly not specific to us or our market, anything like that. So those are caused when there is a hard credit pull. So that's when a full credit report is pulled that we can use for underwriting, for AUS, for Fannie Mae, Freddie Mac findings, everything. So there is an alternative to that, which is a soft credit pull. So it doesn't show us an inquiry on their credit. We get basically all the information from a regular credit pull. So it is something that we were looking at using a little more than we have in the past. And the purpose with doing a soft credit pull versus a hard credit pull would be to give the client to opt out of trigger leads. So it is contrary to the national do not call list. They have to do this in addition. They have to do an opt-out pre-screen. So I have a link here. So what if you're interested, talk with your rep before we have a deal where we're going to pull credit. We can do a soft credit pull to get an idea what their credit looks like. It's not going to allow us to do a full underwrite of the file. The strategy would be we can do a soft credit pull to give them time to opt out. It can take a couple of days for it to go through, but this will save them from getting 20, 30, 40. I've heard as many as 80 calls that people have gotten. It's just ludicrous how much information is being shared. But like I said, it's because there's just not many leads out there for companies to be getting. So they're all going this direction. So if you have a new borrower who we want to try to get them to opt out if they haven't already done this, it's like I said, it's different from the national opt-out. We can do a soft credit pull. We'll get two bureaus. We'll know what their credit looks like and their credit score. We can't run findings to know for sure we're good, but we will have an idea where we sit. So it is a good start to doing a full pre-qual. The strategy, like I said, would be we'll do the soft credit pull, have an idea where they're at, give them a day to opt out, then we'll go back in and do a full credit pull. So that we'll have all three bureaus, all the information, we can have AUS and know for sure we're good to go. So depending upon what that first soft credit pull looks like, we might not be able to give the full green light that they are pre-approved, because if there's some issues on credit, we won't be able to run AUS. Before we can give that pre-approval, we may need to run a full credit bureau to know that we for sure are good, the full credit bureau being a hard pull. So just another option out there, because I have heard from obviously people internal, external, even competitors that I've talked to that have said it's unbelievable the amount of information, not information really, but I guess the number of leads that are being caused by this credit monitoring and the trigger leads. So definitely an inconvenience for clients, for everybody, and oftentimes that gets tied back, to us, to you guys as our partners, that, hey, you guys are sharing our information. It is not that at all. It's an industry-wide problem with the credit monitoring and the credit and the trigger leads. So just let us know when you got a new deal, let your rep know, and we can talk through and see if this makes sense to do. I appreciate everybody joining me here this morning, and please, like I said, follow up with me or your rep here at Tradition with any questions that you do have. And as always, I greatly appreciate all of you and your business here working with us. So if we can help with anything, please let us know. Otherwise, have a great rest of your day. Thanks. Bye-bye.